So as we're looking at investments, the reason why most people take actions and don't get the results they want is because they're not operating from a model that's already been successful. So what I've always done is I've always found that model that was 10, 20, 30 years ahead of me doing exactly what I want to be doing. And then I model after that model. So I got a mentor, Barry Sternlicht. He's a $100 billion guy. He's got assets under management, $100 billion. Just has always been a model for me in terms of like where I want to go, focused on cash flow, focused on building investments, creating value. And I'm really excited to share his thought process with you and then explain it afterwards.
We bought probably now 8 years ago, $5.5 billion portfolio from Sam Zell of apartments. And they were being sold by EQR, which is a company that actually helped start Equity Residential Properties Trust. It was the nation's largest apartment owner. And we bought Atlanta and Charlotte and Raleigh and Florida and all these growth markets in the South, which we were all in. We're busy every day. We're buying stuff. We're seeing the results. We're managing these assets. And he basically concentrated the portfolio in New York and San Francisco, in the cities that up to that time were like, this is where you invested. You were a bi-coastal investor. You invested in the hard to reproduce cities of New York and San Francisco, maybe LA. And we bought the Sunbelt states, and I was like, I knew with certainty that our markets would grow multiples faster than those blue state cities. And people said, oh, Sam's got, the leg on Barry, and Sam didn't have a leg on Barry. His earnings started to come under significant pressure, and we levered our portfolio, and it's been an amazing investment.
In that video, Barry was talking about the Sunbelt markets and how they were going to outperform the bi-coastal big markets like the Californias and the New Yorks. The reason why he was talking about that is because jobs were pouring into the Sunbelt. Like you had Tesla, you had Apple, you had all of these large organizations pouring jobs into Texas, pouring jobs into the Atlanta market. All of those markets were experiencing tremendous job growth. And when you get job growth, the people that are working in these jobs need a place to stay. And then that's when we come into play and we provide housing for those people. So the number one driver of real estate is job growth. And when the jobs come and they stay, the people need a place to live, to raise their families, to go enjoy themselves at. And that's when we come in and we provide housing for them at rental rates that are way more affordable than on those bi-coastal states. So what do I mean by affordability? Well, if you're making $100,000 in the Atlanta market, or you're making $100,000 in the Texas market, right? And your rent's $1,000 a month, right? That's $12,000 for the year. After taxes, when you're paying 50% in taxes, right? You're gonna have $38,000 remaining to spend on whatever you wanna spend on. But if you're out in California and you're out in New York and you're paying $3,000 a month, there's a big difference there. $3,000 a month, and say you doubled your salary there, right? So now you're making 200 grand. After taxes, that's really, 50% tax bracket, you're at 100 grand, right? Now you're spending $36,000 in your rent because you got your $3,000 a month, $36,000. So 100,000 minus 36,000 is going to be 64,000 left to spend on whatever you want. When you're looking at $38,000 remaining and you're making 100,000, you got 38% left. Whereas in this situation, at the end of the year, you have $64,000 left. Now you have 32% of your money left. So the housing affordability is way better in these markets because your cost of living is reduced, which then allows business to actually continue to be more profitable because you don't have to pay your employees sky-high wages for them to be able to have additional money left over to go do entertainment, to put their kids through college, to go do all of those additional things. They can still do it and actually live a way better life in these Sunbelt markets. So the first reason why Barry wanted to move and start buying real estate in the Sunbelt region is for job growth, which then creates population growth. He bought it because of affordability, and affordability for the people that were gonna be living there, which was gonna tremendously increase, especially as those bi-coastal states like California and New York, prices continued to rise there. And the third reason why Barry wanted to invest in those Sunbelt region markets is because he was able to diversify his risk. The price per unit in those markets was significantly reduced in comparison to the Californias and the New Yorks and the Washington DCs. Say a per unit price in Washington DC is 500 grand. And a per unit price down in the Texas or the Atlanta market is 100 grand. That means you can buy 5 units in Atlanta or Texas versus buying 1 unit in those expensive states. So now you have 5 families paying you every single month instead of 1 family paying you every single month. If that 1 family loses their job, gets into a financial situation that they can't handle anymore, or they have a personal problem that's disruptive in their life, now all of a sudden, your $500,000 asset's in trouble. Whereas in that Sunbelt region, if that 1 family gets into trouble, you still have 4 other families to continue to produce and create and pay rent to continue to keep your investment growing and moving forward. So that there's a significant risk diversification that Barry was looking at when he was looking at those Sunbelt markets. I totally agree with what Barry Sternlicht is sharing in that message.
If we get wage inflation, and inflation is driven by wages, which it is happening, that's good for real estate. That means they can pay more in their apartment rents. They don't really care as much about the office rent. I mean, the shocking thing is in markets that have massive direct and indirect vacancy, like New York and San Francisco, and San Francisco is a basket case, rents haven't fallen as much as you would have expected. And because tenants aren't really negotiating. They're just saying, okay, the rents are $50. They're not saying I'll take it to 30. They'll pay 48. Rents in headline rents, they say in New York are down 5%. That's a shocking stat. And look at the recovery of apartments. We're seeing double-digit rent increases, not just in the fast-growing states like Austin or Texas and Florida, but in almost every market we're in, save 1. I think Indianapolis, Columbus, Ohio, and DC are like high single-digit rent increases. Everything else is double-digit, and you wonder how long. It can't go on forever, but industrial, same kind of thing. We own both of those in our non-traded REIT in enormous quantity, $23 billion portfolio, all high quality assets, all bought for that environment, rising rents, which we could see because we have so many apartments. We know exactly what's happening and how to tweak our assumptions based on the reality of what's taking place in the marketplace, like turnover. Turnover is a really important stat in an apartment. How many times are people leaving? Do they leave, or they leave every year, or do they stay extra year? Turnover has been falling because people don't want to move. There's no better deal out there. Everyone's moving rents. Right. So that saves you, $1,000 per unit per year if the guy doesn't leave or the gal doesn't leave. So maybe it's $1,200 now. So that I think the markets rents are more important than interest rates. So if people feel that rents will move up 7%, you can absorb a 1 point increase in Fed funds, 100 basis points, maybe 100 and a quarter. If the short end were to go to 3%, cap rates would probably back up. And but again, are rents rising because for good reason, because wages are going up and company profits are solid? You will buy down the yield on a property if you can capture the growth of rents. And we've seen some crazy trades in the real estate markets, and particularly in multifamily, because rents are up 20% in some cities.
Barry Sternlicht says rents are more important than interest rate increases. So say you have a 100-unit apartment building, you're charging $1,000 a month in rents. At the end of the month, you're going to collect $100K. At the end of the year, that's going to be $1.2 million, right? Because you're going to multiply this by 12. You increase rents by 10%, that's an additional $120,000 in rents, or $1.32 million. So your net increase is $120K. So if on that same 100-unit building, say the value of it is $10 million and you have a 70% loan on that, so your loan is $7 million. You were previously paying 5% on that loan, and now it increased by 1% to 6%. So $7 million at 5% is going to be $350,000 in loan payments. At 5%, that's $350,000. If you have that same $7 million loan and your rates went up to 6%, now you're going to be paying $420,000. So the spread between the $420 and the $350 is $110K, which is less than the 120K you got from your rental increases. So you're still good. You're still good in a rising rate environment with apartments if and only if you can still increase your rents. Because a 10% rent increase is greater than a 1% rate increase in this scenario.
There's also this big arbitrage, which you see all the time, which is not obvious to retail investors. You can buy an individual asset at a better yield than a giant pool, because the institutions want to come in. Let's say I could buy apartments at a 4.5% yield individually, putting out $20 million equity checks at a time. If I can group them together in a multi-billion-dollar portfolio, I could probably sell that portfolio at a 3 yield. And in multiples, because the institutions like a GIC, Government of Singapore, or Temasek, which is a Singapore, or some of the Korean they want to put out $500 million. They don't want to put out $20 million. Right. And they're looking at this as an alternative to bonds, and looking at inflation and saying, I have one of the best protections for inflation I could ever imagine. It's better than a tip.
This is why it's important to do things that are big. Barry Sternlicht said he can buy individual assets at a 4.5% cap rate and then group them all together into a multi-billion-dollar transaction and sell it to an institutional investor at a 3% cap rate. So say you have a property and its NOI, net operating income, is valued at $1 million. And you're buying it at a 4.5% cap rate. And the value equation is equal to value equals NOI, net operating income, divided by the cap rate. So this value here is equal to 22.22 million. If you take that same NOI and you divide it by a 3% cap rate, this value of this investment here at a 3% cap rate is 33.33 million. So when you're thinking bigger, people are all scared about, oh, you're buying at a low cap rate, you're buying at a low cap rate. Well, thinking bigger allows you to still exit at an $11 million gain. So you buy this one deal, $1 million worth of NOI at a 4.5% cap rate. You then package 10 of these deals and then sell those 10 deals at a 3% cap rate, understanding that you're going to be making $11 million on each one of those deals times 10. That $11 million that you increase on that one deal by packaging it together with 10 deals now turns into $110 million as a portfolio that you then go sell off to an institution. Hey there, I hope you enjoyed the video. If you did, please click subscribe down below and give me a thumbs up. You can reach out to me on Instagram or Facebook at Oliver Fernandez 3. I have new videos just like this one dropping every week. So drop a comment down below and let me know what you want to hear next. Until then, keep growing and keep learning. Just do it.